Please stay tuned for important disclosure information at the conclusion of this episode.
This is Destination Retirement with Robert Kuhn from Kuhn Capital Partners. When a part of your financial strategy is out of tune, your long-term goals, your retirement savings, and your legacy can all suffer. With many years of experience in the financial industry, Robert provides his clients and prospects the information they need regarding Social Security, retirement income planning, wealth management, and much more. Listen in as we address your financial concerns and provide helpful strategies to put you on the path to achieving your retirement goals. And now here is Destination Retirement with Robert Kuhn.
Welcome, welcome, welcome. Thanks everybody for joining us this week. My name is Robert Kuhn. I am the president and founder of Kuhn Capital Partners. I'm also the host of this radio show, Destination Retirement. And if you have not listened to us before or caught us live or caught the podcast, welcome. For those listeners who try to tune in each week, welcome to you as well. I hope this show finds everybody doing well. Certainly pretty volatile in the market, obviously. We're going to get into that this week. A lot I start to think about. I think the closer you get to retirement, the more unsettling the current economic and market volatility must be. As fiduciaries, as you know, our job is to identify the most significant risk to your retirement goals and create a portfolio of investments that can hedge against those risks. And that's what we do every day. So a lot of great conversations. I want to thank everybody who continues to reach out each week. We get many calls, and I just think that we're doing our job if we see the call numbers stay consistent. And what I'm most proud of is the podcast numbers. So we do podcast every show. They're going up significantly up and to the right, which is what we want to see. I think that means we're doing our job. And if you've listened before, you know we lead with education. And everything we want to do is to provide a profoundly different investment management experience, because not all advisors are created equal. Hopefully, people are starting to recognize that. So if you'd like to have a conversation with myself this week, you can call Paige. Paige is my great assistant. For those of you who have not had the opportunity to talk to her, she will set a time up this week for us to talk. You can call her at 630-492-1912. 630-492-1912. So banks, can you believe that we're having conversations about banks again? And it's just shocking how fast risk happens. And I was talking with Paige this week, kind of looking at, what we've done last year as far as, who we brought on as new clients and kind of what our goals and objectives are this week, or not this week, but rather this year. And it's so important. And like I stressed to her, that our job is to help those that want help. It's not to try to convince people what they're doing is wrong. It's not to say that our strategy is the best strategy in the world. It's not to show you, like others do, unrealistic, back-tested performance that gets you in as a client, and then they're out the back door once they realize that a lot of what you showed was not real performance. Our job is to truly help those that want help. And we do have a national client base. We do work with commercial airline pilots, and it's a large segment of our client base, albeit a shrinking segment, just given the fact that, the radio and the podcast, obviously the podcast goes, throughout the United States, but certainly the radio show here in Chicago. It's a really interesting story how we got to the niche with the commercial airline pilots, but we'll save that for another day. But, when we look at what we're supposed to do on the radio show is to really make you feel comfortable enough to reach out to us. And that, if we're doing that, I think it's, we're doing our job. And like I told Paige today, I said, these listeners who call in, they don't know us. And we hear often, I've listened to you for 3 months, 6 months, a year, 2 years, whatever. And I finally decided that, it's time to call in. And my only ask of you is don't wait, especially in this market, because, we're just here to try and help. And if you want our help, fantastic. I do believe that these markets are different. And, the old adage is the four most expensive words of investing are it's different this time. But maybe it is different this time. I'm not sure. But, as humans, we generally try and protect against loss or injury in most areas of our life. And when it comes to our investment portfolios, traditional advisors just simply don't build in protection or volatility assets inside of the portfolios that they recommend. It's disheartening because here we are, tremendous risk, absolutely tremendous risk in the market. And I mentioned earlier, the closer you get to retirement, the more unsettling, the current economic and market volatility becomes. And the challenge is what happens. I try to put myself in investor shoes always. I'm 48 and certainly, many working years left, God willing. And we look at, our client base and we look at those individuals who say are in their mid 50s or mid 60s or, in their 70s and they're retiring, what they must think about this volatility, because this is not normal. This is not normal in any way, shape, or form what is going on. And for advisors to dismiss this and to just provide clients with the same old adage of, don't worry about it. Ultimately, basically what they're telling you is if they have a buy and hold strategy is that it's okay to lose money and they're not smart enough to construct portfolios that can lose less when the markets go down. I mean, we have banks failing. Think about that. Banks failing. And we have commercial real estate that is in a world of hurt, allegedly. You've probably heard it just like I have. You have big firms that are in the process of or considering taking large marks on their real estate portfolio and marking those assets down significantly. I don't know if, I don't have firsthand knowledge. All I have is, from people that I speak with or, other publications that we read, but these times are different. And I have to call out the traditional advisor that doesn't have any active management inside of clients' portfolios. I'm a true believer that in this market, you must have some protection. And I think that investing we always look at numbers. And I think I'm guilty of talking too much about performance. Past performance means nothing. And hopefully you realize that when you look at performance from other advisors, and especially if it's back tested and not real, it absolutely means nothing. But I'm guilty of, talking about performance because I think that's what people want. And I think they want outperformance, and I think they want to lose less when the markets go down because it means they're going to make more money. And I had to really kind of check myself and think, especially during these last 2 weeks, that, maybe what people want is peace of mind. And I was talking to my son about this, who runs a hedge fund and his partners at a hedge fund. And, peace of mind, what is that worth to people? And when you look at, especially if you don't have any working years left, what is that peace of mind worth? Is it really that big of a deal if we can outperform the index by 5% or 10%? Sure, it's nice outperformance, but is that going to change your lifestyle? I don't think it's going to. But if you have any questions, obviously, as you know, just give Paige a call, 630-492-1912, 630-492-1912. But I think what those individuals want who kind of are in that, $500,000 to $5 million worth of investable assets, I believe what they want is peace of mind. And so what is peace of mind? Well, to me, peace of mind at that age, as you get closer or near retirement or in retirement, is you probably want to make sure that you have your income needs met. And that probably would alleviate a lot of the headaches that many people are experiencing today. And that kind of dovetails into what is our core, our first core tenet of portfolio construction is protected growth and protected income. And there's great strategies that, can accomplish that. And everybody's different as far as how much they're allocated to that, but it has to go a long way to have your income needs met in retirement through pensions, through Social Security, and then through other guaranteed sources. And when you go through periods like this, and if we do see a significant downturn, and we do see more banks fail, and now again, I say banks fail, it certainly, at least to date, is not reminiscent of 2008, other than some of the headlines. I think the banks are much more financially stable, but that doesn't mean that it's not an issue. And it also doesn't mean that contagion can't happen, especially with interest rates keep going up like they hiked this week. I mean, they want to slow the economy. They want to increase unemployment. So when you look at what peace of mind is to the investor, I have to believe first and foremost, it's okay, I know my income needs are met. And what I find is, if you have under $1 million of investable assets, generally that's your main focus is income. And when I meet with clients that have kind of that $1 to $5 million, worth of investable assets, income is just assumed. And I think that's a wrong assumption, because what's your income plan? Is it just simply the dollar cost average out of your portfolio? I mean, that certainly, is not leveraging the wealth that you have. So when we look at peace of mind, I think peace of mind first and foremost is, do I have the income needs met? And everybody's going to be different. Some people want 100% of their income needs met. They want to know, no matter what happens in the market, no matter what happens in the world, that they're going to get their income regardless of what happens in, over the next 1, 3, 5, 7, 10, 15 years of the market. And that may take up 50% of your portfolio, may take up 100% of your portfolio. Everybody's different. And then you have other people who may only need 50 to 60 to 70% of their income needs met. And that allows them to sleep at night. So when we look at what is going on today, we have to make sure that your income needs are met. And there are some phenomenal strategies that the banks offer, and there's phenomenal strategies that insurance companies offer. And newsflash, there's pros and cons to both. So we want to make sure, first and foremost, I think when you look at the core tenet of a portfolio, if you're nervous right now, and if you've lost money, enough money that has made you feel uncomfortable or kept you up at night, we have to have a conversation. 630-492-1912, because it's my job to, again, identify what the biggest risks are to a successful retirement for you, not for your neighbor, not for your friend, not for my other clients, for you. And then do all we can to construct a portfolio around those risks and making sure that we're doing everything we can to hedge away those risks, because, again, as humans, we want to protect against loss and injury in most areas of our life. It's now time for you to think that way with your portfolio, your investments. Doesn't matter if you have $100,000 or $20 million. Heck, I talked with a client, a potential client a couple of weeks back, $18 million, and he just took $1 million of it and put it in a strategy that guaranteed him income. I mean, think about that. Someone like that, probably you would think they have no care in the world about income, but there are just some great income strategies we can leverage. So when we get back, we're going to talk about the 5 strategies to make retirement savings last. You're listening to Destination Retirement. My name is Robert Kuhn. Give us a call this week. Talk to Paige. Set a time up for us to chat. 630-492-1912, 630-492-1912. More after the break.
Are you considering buying an annuity? Or did you buy an annuity because you were promised stock market-like returns with no downside? If you own the wrong annuity, there is a great chance you've experienced little to no growth over the past few years. In many instances, the insurance agent received more in commission than many have in actual investment growth. If you'd like to learn more about our annuity repair strategy, please call Robert, 800-674-3217. Again, that's 800-674-3217. With Kuhn Capital Partners, partnership isn't just a promise, it's in our name.
Okay, welcome back. You're listening to Destination Retirement. My name is Robert Kuhn. I'm the host of this radio show, and I'm also the president and founder of Kuhn Capital Partners. We're an independent registered investment advisory firm, and yes, we are a fiduciary. I think the job of any advisor, all advisors, unfortunately, I think most traditional advisors fail, but I think my job is to identify your risks, the greatest risks to your retirement goals, to your retirement objectives, and make sure that we're creating a portfolio of investments that can hedge against those risks. I think if we do that, then we're doing our job. And hopefully you recognize that anybody could have made money from 2009 to 2021. It was simple. And a lot of the portfolio flaws that you may not have recognized, but I probably would have immediately, they just didn't matter because markets did nothing but go up. Inflation was non-existent. Stimulus was plentiful. And here we are. Well, now it's the exact opposite. So if the last 18 months have been stressful to you, more stressful to you, you're tired of the lack of proactive approach to money management, the lack of changes to your portfolio to protect, the lack of providing guarantees, the lack of just true overall risk management, then let's have a conversation this week. Call my great assistant Paige, 630-492-1912. 630-492-1912, and she will set a time for us to talk this week. So a couple things on rates. For those that want guaranteed strategies as a bond replacement or as a bond repair strategy, as a reminder, those strategies are offered by banks and insurance companies. There's pros and cons to both. They're different, but yet somewhat similar. The insurance offering currently is still 15% annually, so you get 15% the first 15%. Now, again, that's not a guaranteed 15%. You get 0 to 15% of whatever the S&P 500 does, at least for the next year. That's the current rate, so very, very strong. When you get a gain, that gain's locked in. So if the markets are volatile and they do go down, you're not going to see those gains evaporate. And when the markets do come back, those gains are going to go on top of the other gain, the previous gain. So that's a really, really important strategy, I think, for some people's portfolios today. So 15%, if you have north of $2.2 million of investable assets, make sure that you are reaching out to us and learning more about our opportunity fund. So it's our Opportunity LP. It's our KCP Opportunity Fund LP. It's an unconstrained long-short strategy that, can really go anywhere, follow momentum. And we've had, this market is very conducive for those types of strategies. Again, it's, the simple question is most people don't realize that you can make money when the markets go down if you have the right trade on. And it's kind of a corny analogy, but I ask people, would you get into a car if it didn't have reverse? And of course, the answer is no. And as you know, when we look at portfolio construction inside of that fund, we just want volatility because it doesn't matter if the market's going up or if the market's going down, there's money to be had. And so we look at that as a 10 to 20% weighting of individuals' portfolios. Again, SEC qualifications are 2.2 million, not including your primary residence, or you have to have $1 million with our firm, and then you can have access to that strategy. So if you want to take advantage of the volatility, I really want to have a conversation with you about why that may make some sense to have an allocation to. So 630-492-1912, 630-492-1912. And then lastly, before we get into the 5 strategies to make retirement savings last, if you have mutual funds and you have over $100,000, and especially if it's in a taxable account, please give us a call. Mutual funds are not tax efficient generally. They're not customizable. They're not transparent. You have access to better strategies, individual equities that are managed portfolios that are completely transparent, completely customizable. And it's something that, we can just really, especially in this market, dive deeper to know exactly what you own. So over $100,000, make sure, and in mutual funds or ETFs, make sure you give us a call. So 630-492-1912. Okay, so 5 strategies to make retirement savings last. Probably a good time, for this, I think, as millions of older Americans face a financial puzzle, which is how to spend their hard-earned retirement savings. I mean, let's face it, some people, you're going to spend every penny you have, and that's okay. There's absolutely nothing wrong with that. And others, you're not going to. And we want to look at, legacy planning and how can we make sure that there's enough left for the, future generations. But I think for those investors that may need to tap their retirement savings, I think these times are just different. And I do think it's a financial puzzle. And inside of the financial wealth management industry, it's the term is deaccumulation, which means basically refers to withdrawing safe amounts of money over 2 or 3 decades. The conundrum isn't about building a fancy beach house or moving to Paris. It's about bankrolling general expenses and lifestyle costs over roughly 30 years without earned income from your employment coming in. And you have to make sure that you're very cognizant of certainly taxes, because I don't think very many people believe that taxes are going down. I think it's going to be the exact opposite. But when you look at needing income over 30 years potentially, it's certainly easier said than done. And I think there are variables in that equation that include unexpected costs, market volatility, inflation, bear markets. I mean, you think, this is tough. And if you have a 20 or 30 year time horizon, what are you going to do when we experience 4 or 5 or 6 more of situations like this? It doesn't mean that it's going to be the exact situation, but is your portfolio protected? Is your income, is it guaranteed? Is your income, highly certain to provide the inflation adjusted income that ultimately you're going to need for 20 to 30 years? So there's a lot to think about. And I think when you look at the deaccumulation puzzle, it's immediately complicated for obviously the 68 million boomers that were born between 46 and 65 with what is going on in the market today. What is going on in the market today is high inflation, potentially low growth, and that's a recipe for, things just being challenging. So the old rule of thumb is 4%. And when you look at it, it first emerged 3 decades ago, but the 4% rule captured the minds of financial advisors kind of as a one-size-fits-all solution. I think it was because it was easy to articulate, easy for clients to grasp. And it was created in 1994, which it's, basically the rule of thumb holds that if you have $1 million in retirement savings and you want to cover expected costs over 3 years, you can draw down 4% of your holdings in the first year and then continuously, and you won't run out of money. Well, the challenge with that is it didn't take into consideration what if you have big losses in the beginning? What if interest rates and inflation exceed levels that we have historically experienced? And so Wall Street loves simplicity. They like to sell the 4% rule. It's easy, it's understandable, but it was the brainchild of a now retired financial advisor who, it's just like, I don't know. The 4% rule, I think, is a common rule of thumb, but I think you can do better finding your personalized savings rate. That's what I want to find. What is your personalized savings rate? I think the biggest mistake you can make with the 4% rule is thinking that you have to follow it to the letter, because a couple of things are very wrong with that. The rule assumes a split evenly between stocks and treasury bonds, and that's just, could be a recipe for disaster. And I think if you look at the target date funds, which so many people own, how did they do last year? Well, probably not so good, because interest rates, did what they did. And I've seen safe money go down 15, 20, 30%. And if your safe money lost a substantial amount of money, please give us a call, 630-492-1912. I want to make sure that we have a conversation about how do we repair that? How do we prevent that from happening again? So not only did your equities go down, if your safe money went down last year and even into this year, we just have to have a conversation, 630-492-1912. So I think the 4% rule, it's obviously, something to start with. But again, we want you to we want to generate for you your personalized spending rate. We can do that with our software. We can do that with making sure that we're stress testing your portfolios. We're doing a lot of that, especially if you're not working with us. But there's a lot of things that we can do. So don't think that 4% is a hard and fast rule, because it just doesn't, it doesn't do a good enough job hedging against sequence of return risk. And what that means is if you retire and we have 2 or 3 or 4 down years, which is a very high probability that could happen. I mean, you go back, like I've said, if you've listened to the show, if you bought Microsoft in 2000, it took you 16 years to get back to even. And today, Microsoft and Apple make up 13% of the returns of the S&P 500. Think about that. 13% of the S&P 500 is made up of 2 companies. That we haven't seen anything like that since the late 70s. So it's, these times are different. But I think these times are different, and I love these times because there's opportunity. First off, when there's volatility, there's a ton of money to be made. You can get rich in bear markets. You just don't know it during that time. And here I am again talking about making money rather than providing, peace of mind. But that's what we do. We manage money and we want to make money. So that's so the 4% rule is something to think about and to consider. So when we come back, we're going to get to the next 4 ways that you can make your retirement savings last. My name is Robert Kuhn. You're listening to Destination Retirement. If you'd like to have a conversation with myself this week, give Paige a call, 630-492-1912, 630-492-1912, and she'll set that up. More after the break.
Hoping is good. Knowing is better. You are unique, and your investments and plans should reflect that. Investors today want to find outcomes, not investments that simply track the stock market up and down. Did you know most of all mutual funds and managed accounts by prospectus must stay fully invested no matter how good or bad the stock market is? There is a better way. We want our clients to use portfolio gains to compound their investments, not make up for portfolio losses. Schedule a complimentary call with Robert. With Kuhn Capital Partners, partnership isn't just a promise, it's in our name.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn, president and founder of Kuhn Capital Partners, independent registered investment advisory firm. And yes, we are a fiduciary. I also am the host of this radio show. Hopefully you are finding it educational, because we're going to keep doing it. And I hope that you keep listening. And I do want to ask for anybody who goes to the website, kuhncp.com. And if you want to listen to, all of our past shows, it's very, very transparent. We are as an advisory firm. I mean, not many advisory firms can you look at and go and, listen to 60 whatever plus episodes that we have. And that's not even all of them. but that's all the ones that we have on the website. But, and you can hear what we are saying consistently, and not just, are we just going with the trends? And, we've been saying the same thing pretty much from day one, which is you have to diversify amongst, other investments other than just stocks and bonds. And if you've listened to our show, if we've talked, you know that we have kind of a 3-bucket approach: protected income, growth, and then opportunistic growth. The protected income and protected growth strategies clearly are very popular right now, just given what's going on in the market. And some people need it. And if you're content with currently receiving the first 15% of the S&P and having no potential for loss, and having that strategy that's able to lock in your gains on an annual basis, it's not FDIC insured, but it's insured by the underlying issuer. Those are very, very popular strategies, to the tune of 300 and some odd billion last year. So we want to make sure that, I think that, again, we talked in the first segment about providing peace of mind. I don't talk about it enough, and I should, and I'm guilty of that, because I like to manage money and make money and talk about gains. And I think that when we outperform the S&P 500 and outperform other advisors, and we can look at that tangible performance, I think, wow, we're really doing good. Don't you think, Mr. and Mrs. Client? And, outperformance by 1% or 2 or 3 or 4 or 5 or even 10, that's just not changing a lifestyle. But to lose 20 to 30% of your investable assets when you're in your mid-50s and older, well, you know what? That has an opportunity to change its lifestyle, to change one's lifestyle. And I know there's a lot of people listening that's exactly the case that you're in. And so those are the clients that we want to make sure that the investors that we're reaching out to, and letting you know that, reach out to us, and let's, have a conversation, and let's see if we can help you. Because if you want help, we're willing to do all we can to help you. We will not spend any time on those that don't want help. That is your prerogative not to want help, and our prerogative to not spend any time with you. Because if we're spending time with people who don't want help, we're taking away time that we could be spending on helping those that truly do want help. So 630-492-1912, 630-492-1912. Call Paige this week and set a time up for an introductory call. We're going over the 5 strategies to make retirement savings last. The first was the 4% rule. Another thing that we hear often is this year you can withdraw more than you think. And if you look at last year, for example, it hit a lot of investors with paper and, in some instances, actual losses. Volatility was high. The S&P fell nearly 20%. It was the worst performance since the financial crisis. And bonds, which, again, we have talked about over and over again, and I know I repeat myself, but I know so many people have lost money in bonds, and that's just not okay, especially not okay that an advisor wouldn't have let you, explain to you that oncoming train and what was going to happen in the bond market. That wasn't a surprise. Maybe it was a surprise that rates went up as fast as they did, but the fact that rates went up should not have been a surprise to anybody. So the fact that your safe money is down 10, 15, 20, 25%, 30% in some instances, that wasn't a surprise. And you should have had an advisor that hedged against that, prevented that from happening. And if you didn't, then, again, to me, that warrants a conversation with somebody else. If you want that someone else to be us, my firm, give us a call, 630-492-1912. But bonds generally have been safe. And that's not an excuse, though. It's not an excuse that, well, usually they're okay, Mr. and Mrs. Clients, but this year we just lost 15 to 20%. It's like, my goodness, just because the script was flipped and the U.S. Bloomberg Aggregate Bond Index, which is generally what everybody follows, was down 13% or more, it was truly the worst year in history for many bond strategies. And that's if you had, 10-year and under bonds. You had any long-dated bonds? That's where you get to the 15, 20, 25, 30, 40% range of losses. And so I think when you look at 2002, or I keep saying 2002, I've done that multiple times, but 2022, I think you have to really, step back and look at what can you what can you pull out in income in a year that you're down double digits in your equities, in your fixed income. Because as we talked about the deaccumulation phase, if you look at Mount Everest, I still think this statistic holds true, but more people die coming down from the mountain rather than going up the mountain. And so you have to think about losses when you are still working. They're terrible. I think they're awful, but it's not catastrophic because generally you're still contributing to your 401k and, the losses aren't as magnified. But when you retire and you have no more money to put to work, and you take money out of your portfolio when the market is down 20 to 30%, your portfolio is down 20 to 30%. Well, that's just less money that you have ultimately to grow that money back up. So your rate of return needed to get back to where you once were is much higher. So, we have to make sure that you have some sort of an income strategy that has some high level of predictability, and it can be guaranteed, or there just are, there are great guaranteed strategies, and the banks have some very unique ones. The insurance companies have some very unique ones. And when you see the market, if you had that, again, this message is peace of mind, this show. If you had some income, again, I'm talking to kind of that $1 to $3 million, $1 to $4 million client, that $500,000, dollar client to $3 million client. If you had guaranteed income, that's just generally speaking, a more efficient way to take income, because that's less money that generally you're going to have to allocate of your portfolio to get a decent rate of return as far as cash flow. And then the other money can be used for growth. And if it is guaranteed, you don't have to worry about, taking money out when the market is down. That means your portfolio is down. So now you have to do an even higher rate of return just to get back to even because you have a smaller base. So you have to make sure that, in certain years, you have to really temper or meter your spending. And a lot of clients don't like that. And that's why when people don't have a guaranteed income plan, I don't know what people are doing. I mean, you're just dollar cost averaging out, and you could be dollar cost averaging out at the wrong time. And those are things that you have to really be cognizant of. So, if you don't have a predictable income stream in place, and if you don't have a written retirement plan, those are things that you should have, and we're here to help you if you don't have those. So 630-492-1912, 630-492-1912. So next, let's talk about Roth IRAs and how to blunt the RMD tax hit. Obviously, when you have an IRA, the government says that you're going to, well, it's either 72 or it's increasing to 73, that you have to start taking money out. You know that those are called RMDs. Government wants their taxes, so you have to take that money out. A lot of times individuals don't need to take the money out. They're only taking the money out because the government says you have to. So in your 50s and 60s, let's talk about Roth conversions. That's not a new concept. I mean, that's not revolutionary. Taking a future taxable event and turning that future taxable event into a now taxable event, and then in the Roth, by converting it, all that money is now going to grow tax-free, and you're never going to pay taxes on those assets again. That's not a, that maybe was super popular, or something that most people had never heard of, maybe 6, 7, 8 years ago, 10 years ago, maybe even longer. But here's the strategy. Let's take it one step further. What if we had an investment vehicle that you could invest in that provided significant tax benefits? And so for those clients who are $1 million to $5, $1 million to $10, $1 million to $20 million of investable assets, and if you have a large amount of money in qualified accounts, we need to have a conversation, because what if we can convert that money to a asset, obviously in the Roth, that's going to grow tax free? They're not going to, or you're not going to pay taxes on the gains, rather, and you're not going to be forced to take that money out. Well, what if we had a strategy that we could mitigate some or all of that additional tax due in the year that you convert? So that's what's unique about what we're doing. It's anybody can do a Roth conversion. I mean, that's basic. But how about an investment that can reduce your taxable income, that can then defer or reduce that additional tax due by doing the conversion? So 630-492-1912 if you want to have that conversation. Okay, so 4, and it's in putting this together for this week, hope for the best, expect the worst. I mean, life happens, and we understand that life happens, but I don't think you should expect the worst. I mean, I think the only time that you should expect the worst is if you don't have a plan. And the problem is most people think they have a plan, but they don't have a plan. And most people think they have risk management, but their only risk management is bonds, and then bonds got destroyed last year. And if you think interest rates are going to go back to zero, well, then, stay in that portfolio and you'll make those losses up, rapidly. But if you don't think that, like most people, and we think we're going to stay higher for longer, well, then we have to have a bond replacement strategy, a bond repair strategy. And those are the things that we want to make sure that we're having a conversation with you about. So don't, I don't want to expect the worst. I want to hope for the best, and I want to expect the best, because that's why I'm paying an advisor. The problem is that most advisors don't really truly bring any value. They just bring a portfolio that's going to track the market up, track the market down. When the market's down, they're going to say, don't worry about it. It's going to ultimately come back, feel okay about losing money. Well, my answer would be, what am I paying you for? Because I think that's, ultimately your job is to help us, lose less when ultimately the markets go down. So it's certainly, I think people are starting to realize that maybe it wasn't their advisor that made them all that money over the last handful of years. Maybe it was just simply the market. So if you want to have a conversation, give Paige a call this week, 630-492-1912, 630-492-1912. More after the break.
Would you like your portfolio to be more certain in uncertain times? These days, there are more questions than ever. Before we can get to the answers, we have a question for you. What do you want to accomplish? Understanding the bigger picture is the first step to helping you pursue your goals today, tomorrow, and for generations to come. To schedule a complimentary call with Robert, please call 800-674-3217. Again, that's 800-674-3217. With Kuhn Capital Partners, partnership isn't just a promise, it's in our name.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn, president and founder of Kuhn Capital Partners, independent registered investment advisory firm and fiduciary. Thank you for listening to the show this week. I know it's been challenging. I know the closer you get to retirement, or if you're in retirement, these markets are very stressful. My ask of you is to do something about it and allow us to help you make sure that we're providing you with a level of peace of mind, a level of certainty that you may not have currently. Because it's not, in our opinion, it's not going to get a whole lot easier over the next couple of years. If anything, it could get much more messy and much more volatile. And selfishly, that wouldn't be the end of the world, because I think if investors are positioned correctly, there's money to be had. And that's the job of an advisor. Make money no matter what, or lose less in downtime. So with that being said, if you want to have a conversation this week, I'd love to have that conversation with you. You can call Paige. Paige is my assistant. She's fantastic. If you haven't had the opportunity to meet with her, if clients are listening, I'm sure you can attest to the fact that we want to make working with us very easy. And we want to make sure that we respond. Again, peace of mind. That's the whole purpose of this show, is creating peace of mind. That peace of mind also comes from the service side, not calling an 800 number, not sitting there waiting on hold forever. It's shocking to me that, people would put up with that in this day and age, but they do, But anyways, if you want to have a conversation with us, give us a call this week, 630-492-1912, 630-492-1912. Visit the website, kuhncp.com, kuhncp.com. So we've been talking about the 5 ways to make your retirement savings last longer. And I think the last one is, we titled it Flex. And it's probably my favorite. And it's also the most simplistic, but it's also the feature or quality, I think, that most individual investors ignore. And I don't think it's that you don't want to pay attention to it. I just think you don't know how to. So we titled it Flex. And like high rises in California that are built on rollers so that they wobble during an earthquake rather than collapse, I think retirees need to avoid being rigid. You have to make sure that you are remaining flexible and willing to alter your strategy as necessary. To me, that is the number one rule of investing, is that you have to remain flexible and you have to alter your strategy as necessary. But unfortunately, advisors don't do it. And traditional advisors, they just simply don't do it. They might be managing 100 million, 300 million, 500 million. They're getting 1%, 2% on that asset base. So they're making, 7 figures, and they just don't want to upset the apple cart. And that's, I think, what gives this industry a bad name. And I think that's why you have clients who are just on that proverbial Wall Street roller coaster that all you have to do is look at CNBC, and if the arrow's up, you made money. If the arrow's down, you lost money. That's an issue. And it's something that we spent 25 years, and we're still going strong at it to try to really let clients know that if the advisor that you're currently working with is not providing a proactive risk management, tax mitigation, financial planning strategy, you have to alter your strategy, especially in this market. And I think when you do that, you're going to realize that it's very easy to move money, and it's very easy to break up with an advisor. And at the end of the day, you don't owe us anything. You owe yourself, your family, future generations, whatever it is that your goals and objectives are, that's your loyalty. It's not to an advisor that refuses to change with the times, because these markets are different. And like I've said multiple times, buy and hold may work 70 to 80% of the time. But in that 20%, it's going to cause unneeded stress, especially if you're retired, and it's just not going to give you peace of mind. And you have to get outside of the thinking, or out of the thought process, rather, of, well, everybody's losing money. Well, no. Our opportunistic fund, I love these markets because, the challenge is when you work with us, we can be both a bull and a bear. We don't just have to be all overly bullish all the time. I mean, there are times, especially in this market, it's like I've changed my mind 3 times in a day. Now, we want to be measured, and we don't want to be making changes unnecessarily. But if people are telling you, advisors especially, if they're telling you that they're not changing their mind more than they probably have ever in their career, they're probably not being honest with you. So we want to bring back all of what we're doing and really just boil it down in a very simplistic way. You want a portfolio that has 3 distinctly different strategies, different return drivers, different protection measures. The first bucket, again, the protection bucket, right? Some people are going to overweight that. Some are going to underweight it. That's completely up to you as we go through the financial planning process. But that protection bucket is there for markets like this. You can guarantee income. You can guarantee principal by the issuer, of course, not FDIC insured, but it's by the issuer, which, you buy a JP Morgan bond, that bond isn't, FDIC insured. But if we're dealing with very reputable, the best, what we believe the best of the best, it's, we think it's money good. But when you look at that protection bucket, for some people, it's going to be 20% of their portfolio. For some people, it's going to be 80% of their portfolio. But when you have that protection bucket in place, well, you have an income strategy that you could go up with inflation, is guaranteed for either you or you and your spouse. And that just frees up money to go into the other two buckets. And the second bucket is our growth bucket. And if you've listened to us at all, you know that I think the first litmus test is if you have $100,000 invested, over $100,000, I don't care if it's 20 million, 10 million, 5 million, but if it's over $100,000 and you're in mutual funds or ETFs, we have to have a conversation because I know there's a better way. And so when you look at the growth bucket, we want to make sure that it's forward looking. We want to make sure that we're bringing a multi-manager approach to the table, the best of the best, creating a portfolio of managers that have individual stocks that you have a cost basis that work very well together. And we have an institutional research partner that advises on close to $3 trillion. And we have a relationship with them in place. And I can promise you that when they call managers, those managers are picking up the phone. And so if we can craft a portfolio of 3 or 4 or 5 different managers in the large cap space, ones that are great at value, ones that are great at growth, ones that are great at aggressive growth and value growth, and bring you a multi-manager approach in a seamless portfolio of one, it's phenomenal. So we can do that in the large cap space, we can do that in the small and mid, and then in the international space. And all the managers are different. And so we're not beholden to anybody. We're bringing in institutional research firms that manage $400 billion, advise on close to $3 trillion, and they have the access, they have the research, they have the, they just are going to get the meetings. And when they can craft a portfolio and you have your own personal CFA, certified financial analyst, that is on that portfolio, well, that's a great strategy rather than just a bunch of mutual funds or some managed account. I met with a client potential client the other day. He had all of his money with one manager, a decent manager, but ultra aggressive manager. But you can't be one manager. Do you want one or do you want 5 of the best? And most people are going to go with 5 of the best. So, and then when you look at the last bucket, the opportunistic bucket, I think that's the most fun bucket because that's where we can be aggressive. We can be, as aggressive as we need to be, as conservative as we need to be. We can go short the market, long the market. We can use leverage when the opportunity presents itself. It's unconstrained. It's go anywhere. You can follow the money flow. You can do momentum. You can do mean variance. There's so many different strategies that you can do there. And that may only make up 10% of your portfolio or 15% of your portfolio. But guess what? In periods like we're at right now, if your equities are down, well, this bucket may be able to make up for those strategies and those losses. So for that, we have a fund. Again, there are some income net worth requirements for the fund. If you don't meet those net worth requirements, they're not our net worth requirements. They're the SEC's net worth requirements. Then we can talk about how we could replicate that outside of the fund, which we do. It's not as flexible, but there's still a significant amount of opportunity as well. But when you have those 3 buckets, and if you have that protection, that growth, and then that opportunistic growth, I don't think you're as concerned in periods like we're going through right now. I think what you're going to find is that you're going to find opportunity. You're going to find these markets we can be opportunistic. Rather than being controlled by the volatility, we can actually take advantage of the volatility. And if you look at, for example, in the opportunistic fund, we were bullish 3 times last week and we were bearish 2 times last week. And we were net positive, last week, and we had a phenomenal week. Now, again, past performance doesn't mean a whole lot, but it all comes down to flexibility. And if you look at the last point we talked about of the show, and we entitled it Flex, you have to remain flexible. You must be willing to alter your strategy as necessary. And if you don't have the right strategy, then what's insanity? The definition of insanity is doing the same thing and expecting different results. I mean, we're in a thinly traded market here. And if we're not going to go vertical, you have to look at things differently to make money. Or else you're just going to go up, you're going to go down. You're going to go up, you're going to go down. You're going to go up and you're going to go down. And I think you're going to get frustrated. So with that being said, hopefully you got something out of this show. If you did, give us a call, 630-492-1912, 630-492-1912. Talk with Paige. She'll set a time for us to talk this week. Don't wait. You know, I hear over and over again, I've listened to you forever. I finally decide to call. We're about as laid back as we can be on our calls again. We want to make sure we're helping those that want help. These markets are different, so my ask of you is don't wait. If you want to listen to past shows, go to kuhncp.com, kuhncp.com. Have a profitable week, and we look forward to being back with you next Saturday. Take care.
Thank you for listening to Destination Retirement. Don't pay too much for taxes or retire without a sound retirement plan. For more information, please contact Robert Kuhn from Kuhn Capital Partners. Call 630-492-1912 or visit them online at kuhncp.com.
This recording is for informational purposes only and should not be considered investment advice. Kuhn Capital Partners does not provide legal, accounting, or tax advice. Any statement regarding such matters is explanatory and may not be relied upon as definitive advice. Opinions expressed are current as of the date of this recording, and such opinions are subject to change. The views and opinions of guests on this program are not necessarily those of Kuhn Capital Partners. Any reference to guarantees, principal or income, protection, buffers, or defined outcome investments are generally structured notes or fixed insurance products backed by the claims-paying ability of the offering company and are not insured by any government agency. Kuhn Capital Partners is not affiliated with any guests unless otherwise stated and does not guarantee the accuracy or the completeness of any data presented. Kuhn Capital Partners and its affiliates are not responsible for any trading decisions, damages, or other losses resulting from or related to the information, data analysis, or opinions in this recording. Past performance is not a guarantee of future results. All investments are subject to investment risk, including but not limited to the potential loss of principal. Advisory services are offered through Kuhn Capital Partners, LLC, a registered investment advisor.